Thank you everyone for being here today. So we're really excited to present our capstone work with you all on financing the 21st century energy company. So we worked with a Texas-based company, Nexus Renewable Power, a company that finances, develops, operates solar and energy assets in Texas. So before we dive in, I'll introduce you to our team. My name is Michelle, and then we have Jay on the end there, Graham, Livia, and Jacob. And we were really excited to dive in. So Nexus really wants to expand, but they do have some capital inefficiencies, and they need more capital to do so. And so what we did is we kind of broke our project into 4 parts, which will also serve as kind of our roadmap for you all. So over the past few months, we first started with doing a deep dive into Nexus itself. Of course, we had to understand who Nexus was, who they are currently, and where they want to be. Then we wanted to level set. So we looked at different capital sources and explored what some of those potential resources were. Then we did an analysis and really wanted to get some market research and be able to use things to benchmark different decision-making points and strategies into our recommendations. We also did a comparable deal analysis to get some quantitative and qualitative insights. Finally, I'll mention this is not part of our presentation, but we did write a case study, which we hope to get published and share our journey of this project.
Yeah, so for the first part of our project, we're just going to deep dive into what Nexus is. So we'll just give you a brief snapshot. Firstly, Nexus is a Texas-based solar company. They do both the solar as well as the battery storage side of things. So currently they have a total of 6 projects in the pipeline. The first one's going to end the end of this year, while the last one's going to end at the end of 2028. They have a total of 1 gigawatts in the solar capacity as well as 1.5 in the battery storage capacity. Interestingly, they also have the maximum site capacity is 200 megawatts, while the battery storage side of things, the maximum is 500 megawatts. Our job that we found was to redesign their capital stack. So this looked like looking at their TopCo equity, some of their tax equity structures, alternative financing solutions, as well as credit facility enhancements. So once again, redesigning the capital stack, and Michelle's going to touch on this.
Thank you. So as Jacob mentioned, just to kind of give you a very high-level overview to level set. So these are all different forms of capital, and we've mapped them out by risk and return profiles. So you can see on the bottom, we have the lower risk, low return. So debt is the cheapest form of capital. And then if you make your way all the way up to the top, you have equity, which is the higher risk and higher return because you have access to the full appreciation. And then there are, so many different things we looked into in between as different sources of capital, all with pros and cons. And this mapping really helps you assess what those targeted decisions can be based on your risk tolerance and what kind of returns you want on things.
So moving to our analysis, we started looking at some of the peer companies in the group to kind of get some insights into how they were financing their assets. So first we looked at public utility scale solar companies, as there was a lot of information available, but they're much less comparable to Nexus just because they're so much larger. However, we were still able to get some kind of key benchmark insights for growth in the industry. So of the public comps, they had a weighted average cost of capital around 5%, much less than Nexus's, and also had leverage of around 65%, much less than Nexus's, which kind of indicates that in the industry, to get investment grade lending, more equity would be required. Then we moved on to some of the private comps, much more comparable to Nexus, but very limited data availability. However, we were still able to get some key insights, first being that of the 14 most comparable firms, 9 were primarily backed by private equity, and then of the firms that were primarily debt financed, they were much more mature project pipelines than Nexus. Additionally, there's a lot of activity which shows that investors are familiar with the risk and are confident in the market. Then we moved on to some industry aspects that could impact Nexus's financing. So first, with tax equity uncertainty on the proposed tax bill, moving fast to get capital and preserve that tax equity would be very beneficial. Additionally, Nexus is using a quasi-merchant sales strategy, meaning they intend to sell less than 100% of their generation through structured offtakes, choosing to sell a portion to the market as part of their investment thesis. This is actually very uncommon in renewables and often comes with increased lending terms in other energy markets. Then moving on to ERCOT, which is Texas's deregulated electricity grid, which brings its own risks, as investors call it the Wild West of energy markets. And then lastly, Nexus just being a small, new, unproven firm, investors and lenders will see this as inherent risk.
We wanted to, excuse me, we wanted to look into a couple case studies to really educate our research. So SunPower and SunEdison were both solar powerhouses in the residential and commercial and industrial industry respectively, but unfortunately through scaling too quickly and over leveraging themselves, they both had to file for bankruptcy. So SunPower had around over $2 billion in liabilities when they filed for bankruptcy in 2024, and SunEdison had around $16 billion in debt when they filed in 2016. Our key takeaways here really were that scaling smartly is critical. So institutional rigor, such as transparent governance and risk controls, are really key, as well as being proactive with the policy changes, kind of like Graham had mentioned, with some of the subsidies and tax credits being amended currently, as well as having diverse exit options so that if one doesn't work, you don't get stuck and you can move forward with another. But beyond looking at some unfortunate financial situations, we did want to look into a novel form of capital for the company, and we landed on asset-backed securities. So DSD Connect is one of the only companies that has done an asset-backed security, and they did that in the residential space. They lumped together 116 projects over 11 states that was valued at $150 million. So 112.5 of that was in Class A principal, with the rest being in Class B. And while this is not a viable option for Nexus right now, given they only have a 6-project pipeline, as they scale and continue to build their project portfolio, we really believe that looking into structuring an asset-backed security would accelerate their growth, particularly because it appeals to other forms of investors like institutional investors, pension funds, sometimes family offices that provide longer-term capital or the stickier capital that they often told us that they're chasing.
All right, so on that note, we have identified 4 possible scenarios of how Nexus could potentially finance their projects. Those are top co-equity investment, mezzanine debt, special purpose vehicles, and finally asset-backed security, like Olivia mentioned. But what we wanted to highlight for our client was basically we wanted them to have flexibility and adaptability as their key priority, as the market itself is very interesting with the dynamics of what's going on these days, as well as the company itself and the general external issue that surrounds the solar market. So by saying this, we highlighted the importance of creating a hybrid capital stack so that Nexus has those prior understanding of the market, as well as the flexibility to pivot accordingly as the dynamic changes. Therefore, that was our conclusion. And moving on to the key takeaway.
So as you kind of all heard, there's really no one-size-fits-all approach when it comes to capital. Every capital source has its own opportunities and trade-offs. And so Nexus really needs to look into what fits their portfolio. As Graham had mentioned, ERCOT is also very risky, and so market context really matters here. So staying proactive with the policy changes. And then lastly, the real world is really messy. Capital is important, but so is building relationships, the timing of when your projects are, and also your risk for appetite. Or your appetite for risk, sorry. So we just want to give a quick thank you to Sargon, Daniel, and Philip. They were really great partners to us over the last couple months. We learned a lot from them, and I think we all found this a really meaningful project. Daniel had a baby mid-semester, and he still was really proactive working with us.
Thank you.
Thank you.